And welcome back to the show this morning. Get by the website, realinvestmentadvice.com. Michael Lebowitz, CFA, joining us, talking a little bit about the debt and, of course, why this is important, as particularly as we get into a function of an environment which is, is interesting to me because, during the previous administration, conservatives railed against this idea of kind of runaway debt and spending, and yet we're running up debt faster and running a bigger deficit than we were previously. And we're doing that at a time that the economy is in a very late stage economic expansion. And, one of the things that has been talked about a lot lately, of course, is the Federal Reserve. And, of course, Donald Trump out yesterday suggesting that the Federal Reserve needs to cut rates and do more QE right away to help support the economy. But that in and of itself is also problematic when you look at where we are within the cycle. And we've talked about this before on the show, is that, lowering rates and doing things like quantitative easing, which is where the Federal Reserve buys treasuries out of the market and provides liquidity to the market. It's great to help asset prices go up, but asset prices as a function don't impact a vast majority of America. Only about 10 to 15% of Americans actually have money invested in the financial markets. And so we talk about the wealth gap, and of course, that's one of the bigger problems that exists today. But the economic prosperity that comes from artificial stimulus really hasn't been present. Again, this is why ultimately the economy runs at about 2% growth. It runs about the same rate as population growth over time. And yes, while we had an economic bump in 2018, that was on the back of massive stimulus coming from 3 hurricanes, 2 major wildfires, and that's now worked its way through the system. And unfortunately, because of the trade war, all the effects that were coming from tax cuts have now been absorbed as well. So without some type of further stimulus, the economy continues to grind slower and slower here. We're looking at putting out about a 1.5% growth rate in quarter 2, about 1.5% to 1% in quarter 3. That's bringing us back to that average rate of growth of about 2%. Mike, what do you think?
Well, let's think about that in reverse to help cement some of what you were saying. The government spent over $1 trillion last year. So I'm not talking about their deficit. I'm talking about how much their debt issuance actually increased, because that's what I consider the deficit. The deficit, as reported, which was still 800 or 900 billion, it includes some tricky accounting that doesn't get you to the bottom line. So the government spends $1 trillion, $1.1 trillion. And what if this year it only spends 300 billion? That means it's spending 700 or 800 billion less than it did the year before. And I guarantee you the economy will fall 3 or 4% a year if that's the case. So this is why the economy is growing. It's because we're spending, and the government is spending an awful lot of money. And if you take that money away from the government, if you tell them they can't spend it, it's going to show you the true state of the economy. And it's not a very pretty picture.
Well, yeah, and actually we just did a chart on this on Monday. We have a report out on our website that we published out on Monday talking about the economy. And, if you take a look at going back to 1980 as an example and subtract out the amount of debt that we've been using to stimulate growth in the economy, yes, the economy is about 18 trillion, 19 trillion on an inflation adjusted basis today. If you took out all the debt, you'd actually have a negative growth rate in the economy for like the last 20 years, to a very large degree, because we've used so much debt to help pay for growth. And this is why we're running over 100% of debt to GDP now. And historically, that if you look at Japan, you look at other countries that have done that, where they've run excessively high debt balances, the one thing they can't generate is higher rates of inflation, higher rates of economic growth. And this is what's really stumped the Federal Reserve. They can't figure out why they can't get higher rates of inflation.
Right. And you can add demographics to that too. But let's think about what we were talking about a few minutes ago, that we were able to do this because foreign governments and foreign investors were funding us. They kept lending us money to buy stuff. So it worked out well. But now that onus is falling upon ourselves, and it's a very different story. So the concept of 1.5% growth going forward is what we should be expecting. It's not the anomaly.
Right. And this is the other question really that comes down to this is, of course, Donald Trump's coming out He's really been pushing hard on the Federal Reserve to engage in dropping rates, really pushing hard for them to start quantitative easing again because, he even used China as an example. Look, China does it. Why can't we do it? But it's not all just a net positive benefit of the Fed lowering rates and doing QE. Yes, you may get higher asset prices in the short term, but, in the longer term, there are negative consequences of doing that action.
That's right. And we wrote about that in last week's article, Pay It Forward, that at some point you have to pay the piper. And we're seeing a little bit of that now, but if the Fed goes and lowers rates more, it makes the onus of the debt a little bit less, but it just pushes out that ultimate cost. And that ultimate cost is ultimately on how much the economy can grow, or if it can grow at all at some point.
Well, yeah, and that's of course that's the bigger question, of course. And again, and as we look at this, we talked about this a bit yesterday on the show, is that we're 10 years into an economic cycle. If you're going to, for instance, when do things work the best? If I want to help somebody, and I want to give somebody some money, what helps the person the most? If I give somebody that absolutely has no money and I give them money, does that help them more than me giving money to a millionaire, right? And that's kind of the same way with the economy. In 2008, 2009, the economy was broke, from a literal standpoint, which is, we were super high unemployment or double-digit unemployment rates. You had valuations had dropped in the financial markets. People were completely, distraught about the financial situation of the country. People were losing their homes. So you come in with this stimulus. It's like giving money to a very poor person. It has a big benefit at that point. And here we're talking about doing it now that we've got the economy, we've got ultra low unemployment, 3.8% on an unemployment rate. Consumer confidence is high. Stocks are close to an all-time record high, not too far off the record highs. Everything really is about as good as it can get. So hitting the economy with stimulus now is going to have a lot less effect than it did, 10 years ago.
That's right. That's right. And we've said this numerous times. The Fed is quickly running out of powder. They're running out of powder. They have very little they can do. Yes, they can lower rates, but are we really going to take on new mortgages? A lot of mortgages are already 3 to 4%. What are we going to refi to? So we can't refi. Auto loans have been zero or close to zero for the last 10 years. Mm-hmm. So there's no additional incentive to buy cars unless I guess you get to negative interest rates. And corporations, and we've talked about this a lot too, are filled with debt. There are so many companies that are triple B right now as a percentage of the corporate bond universe that they can't afford to borrow more, or they're going to push themselves into junk territory. So the private sector, be it corporations or individuals, just even if you do lower rates, their ability to borrow more and to spend and to marginally boost the economy is very limited. And then that gets you to the government. And the government has been running trillion-dollar deficits the last year and a half. But how much more can they do, especially if it has to be funded by the U.S. citizen? And I think at the end of the day, Lance, where this really ends up is the case for more QE, because $1 trillion can't really be funded by the U.S., be it mutual funds or citizens or whoever else. And that's where the Fed is going to come in and basically help fund the government.
Well, and again, but that's, and it sounds, kind of
magical.
Yeah, well, it does. And it doesn't sound like any big thing. Okay, so the Fed comes in, they buy the treasuries, but the Fed has no real money. They have to actually create digital currency, so to speak. They credit bank reserves, they buy the debt, and then basically they recycle the interest payments back to the government. So the Treasury pays the interest payments on the debt. The Federal Reserve buys the bonds, and then the interest that comes in from the bonds from the Treasury, the Fed gives back to the Treasury. So it's almost like we're creating our own little internal Ponzi scheme within the government of just issuing debt. The Fed buys it, remits the interest payment back. And here's the interesting part. The Treasury counts the expense of paying out the interest payment, and then when the Fed gives it back, it's income for the government. So, but it's the same exact dollar, just making the loop. But that's an end game that, while it sounds, in theory that you could just do this to any degree, there is an end game to that because, again, the Federal Reserve can't be the only buyer of treasuries.
That's right. That's right. But I think that's the road we're on. And here's what's funny. both political parties seem to endorse some version of that, right? The liberals are coming up with MMT and various versions where basically the Fed prints money to fund the deficit. And we're hearing Trump now every day saying he wants the Fed to lower rates to bring back QE. It's a different way of doing it, but it's doing the same exact thing.
Right.
So I think it's becoming a common thread, whether you're very conservative or very liberal. And that's scary to me because there's some big repercussions with that type of policy.
Right, but I think that's the problem itself is that, people that call themselves conservatives, like I'm a conservative Republican, I'm a fiscal conservative, right? So what I don't want is I don't want a very debt-laden economy because there's consequences for that. But, a lot of people that call themselves conservatives even today, and I see this a lot in the media, is they're completely endorsing this idea. It's like this is a great idea. We just have the Fed do QE. That boosts the economy. Everything's great. We just never have a recession again. There's a huge consequence of that debt down the road. And this idea that debts and deficits don't matter is very dangerous because you can look at other countries that have run the same gamut and it doesn't turn out well, over a long-term period. Yeah, we may get away with it another decade, maybe another 2 decades, may be great, but the long-term consequence of that is not going to be good for future generations.
That's right. I mean, there's books written on this, and go back as far as you want in history. It has never worked out well.
Yep. All right, that wraps it up for the day. Mike, thanks for joining us today. We appreciate it. Be sure and get by the website, realinvestmentadvice.com. Mike's latest article is out talking about who actually is buying our debt. That's on the website now at realinvestmentadvice.com. While you're there, you can get registered for our upcoming class that we have. That schedule is always posted on the website as well under our events tab. And of course, yesterday, we released a really good podcast with Kevin Duffy, who is the Chief Investment Officer for Bearing Asset Management, talking about the markets, where we are, the current cycle, what it means for your money. And again, that podcast is now out. Simply go click on our YouTube tab. You can watch it there. If you subscribe to our YouTube channel, we'll keep you updated on all of our podcasts. We did another one yesterday. We'll be releasing here soon. We've got new stuff coming out all the time. It's all at the website, realinvestmentadvice.com. Have a great day. We'll see you next time on the next edition of the Lance Roberts Show.
Money, 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 must be funny in a rich man's world. Money, 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 always sunny in a rich man's world. All the things I could do if I had a little money.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.